Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, April 26, 2023, and this is Blockhead Traders Weekly. In this week's episode, we are going to take a look at a couple of topics here this week. It wouldn't be complete if we didn't touch on FRC, or First Republic Bank, which has been the center of all the news cycles lately and just massive trading volume. And we're going to ask the question, should you trade it? Then we're going to touch on a little topic called early assignment risk with options, and it's related to FRC, and it's something that we haven't talked a ton about on the show, but it's early option assignment where you, the option seller, can get assigned things a little bit sooner than you might think. And then lastly, we're going to touch on a topic. It's an interesting crypto concept. I call it a project here. We're going to use a project as an example, but really what we're going to focus on is the concept of what it is in decentralized finance. And it essentially allows you to accumulate a particular asset or token of class while maintaining leverage against it. So it kind of lets you help build up that accumulation a little bit faster with leveraged and borrowed funds. And so it's kind of interesting, and we'll touch on that a little bit later in the show. But before we hop to some of that content, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what type of content you're interested in or what you're trading today. You can also pick this up wherever you get your podcasts. If you can't find it there, let us know and we will get it there. Lastly, thetagang.com/sprocket888 is where I post all of my trades, the good, the bad, and the ugly. But Viper, let's hop to this week's content here. And first up on our docket is First Republic Bank. And this is, this was the center of the big collapse of things at the beginning of March, around March 10th. March 12th through that weekend, there was Silicon Valley Bank, Signature Bank, First Republic Bank was in there. There was a whole host of them where they effectively got a little too, I'll say, underwater in their positions, and there was mass exodus of depositors, effectively creating an old school run on the bank. Where there wasn't a lot of things in there. And First Republic was one of the ones that didn't shut down back then, but they were really at the center of the attention because they catered to what were more known as high wealth investors and high wealth individuals. So most of those individuals had well in excess of $250,000 of deposits in the bank. And when there started to become these whiffs of bank runs, one of the things in the United States is this FDIC insurance, which will insure depositors up to $250,000. And anything over that is uninsured effectively. And so what happened in First Republic Bank is a lot of these very wealthy depositors started pulling their funds out of the bank down to that $250,000 threshold, saying, hey, I don't know what's going on, but I need to protect my assets, so I'm pulling my money out. And this put a massive shock into First Republic and other banks too, for that matter. Interesting thing was, more recently, they had their earnings announcement where they started kind of talking about what kind of happened and publicly disclosing some things. One of the interesting statistics that I remember reading, and I'll probably get the exact number wrong, but it was somewhere around like 92 or 95% of the First Republic customer base is actually still a First Republic customer, kind of indicating to me that the people that had their money there didn't really leave the bank totally, but they brought their deposits down under that $250,000 threshold. Anyway, why all this is coming up is because they've kind of been teetering on the edge of bye-bye. And there's been talks that the FDIC might come in for solvency issues and take receivership of the bank, which who knows, by the time this comes out, maybe that actually already will have happened. But it's nothing attracts traders like panic and blood in the water. And First Republic has all of those signs. Before we'll have Viper pull up a chart here and we'll take a look at it. But before we hop to that, just to give you like an order of magnitude of what we're dealing with here, and you'll see some of the volume in the chart. Today was one of the first days post earnings. It's actually the second day post earnings. Their earnings came out 2 days ago. They lost 50% of their value on the day after earnings. Then today, which is the second day after that, they lost another 30% of the value. Keep in mind, they had already fallen 90% from prior to March. There's 186 million shares, I believe, for this company outstanding to be trading in the world. And today, 200 million shares traded hands. So just, I don't know how many times it hit the circuit breaker today. I think it probably hit it. I think I saw 3 times at least in the early morning, not early morning, but basically after open. I think it hit it like for every 20 minutes or something like that. But yeah, Viper, let's switch over here to the chart. And what are your thoughts here on FRC? You want to add any color commentary?
Yeah. So this is, there's a thing I keep hearing over the past, we're going on like 3.5 years now. Little dramatic, but I feel like it's appropriate. So, the headline is Millennials Experience Yet Another Once in a Lifetime Event. So, I feel like that's where we're at is, every week we get another one. So yeah, this is the FRC chart. A couple things that I want to call out is just like you said, I do have volume charted down here on the bottom, and we'll see it a little more when I zoom in, but I wanted this zoomed out view is because you don't see the volume all the way back to 2021. And if we keep going back in the chart, you don't see the volume. It's so low by comparison to what just happened. And you can see this first major drop here. This is March. This is the big, quote unquote, big run on the banks. And honestly, I got to say, I thought that was it. I thought that was the big thing. I thought we got SVB, Silvergate, and one other one that went down then. And I was like, okay, it's been a while. I think we're good. And you can see down here on the volume chart, volume definitely picked up to all-time highs. And then as we keep going, it goes up a little bit higher. And then today, yesterday, or the last couple days, it's just, I mean, I don't even know the English language has a word for that when, comparing the multiples of what the volume normally was, what it is here. Like you said, over every, at least one of every single stock traded hands in volume is just outrageous. So we see the big crash there. Now we have to zoom in to see the next big crash. Because we were all the way down there. I charted this level here, and this was kind of the level that we were looking at in the Discord before the earnings call. So the day before the day of earnings, the thing went on. I guess all things considered, I'll say a massive tear. But the day of earnings, we just went flying up here. I do have extended hours trading turned on this chart, so that way the chart looks a little more continuous. So this peg, holy cow. I had this level drawn before earnings, and it just came up perfectly, kissed the prior resistance, and then we were gonzo after earnings. And so all in after hours trading, gapped way down, and then we opened up the next day. Like you said, we dumped 50% on that. And then we just kind of keep going and keep bleeding out here. So, it raises the question. We talk all the time on here about the power of options and the premium selling strategy of volatility is the thing, the order of the day, an IV percentile. So nothing was more juiced for volatility and IV percentile than this thing. But that doesn't, as we're learning in real time, both of us, both Sprocket and I, have a trade on this. And we're learning whether or not that's a good idea. So let me chart my play real quick. I, on the open after a dump, and we came down just below prior lows here. So we were officially in uncharted waters, price discovery mode. I went ahead here. I anchor, again, like all my charts, I anchor the play to the candle in which I opened it at, but the level is charted at the strike that I sold. So I sold one contract for $1.60 at the $10 strike. And as you can see, I am not doing well on that. I mean, the contract alone, like today, because now we're into intrinsic value of the contract and all that kind of stuff. But nonetheless, the contract today peaked up to, I think, almost $8. So it's bad. But that's not the only risk here, because the risk now is this is deep in the money, and we're now looking at additional risks, and that's, like we said at the top of the show, the risk of early assignment. So, Rocket, I don't know if you want to talk about your trade that's on this, and kind of go over what we're hedging our bets on, our side wagers of what's going to happen tomorrow morning when the market opens, and we're not worried about price action.
That's right. That's right. Yeah. So, I'm going to touch here a little bit on early assignment. We'll leave Viper's thing up there. We'll use that as an example. Let's say that I don't have as Viper's looks a lot healthier than my trade. Let's put it that way for right now. Want to answer one of the questions that says, should you trade this? Viper and I, we tried this out because, man, I love volatility, and sometimes I just can't resist. And part of going into the trade is knowing, hey, are you cool with losing your max loss on this trade? So I will clarify that definitely went into my decision to enter this, and you'll hear me be sad if this ends up being a loser, but it's not. I didn't put the family home up for collateral or anything like that. It's position sizing. And I think actually Viper mentioned in the Discord today, well, it's a good thing I followed position sizing, because if this thing goes kaboom, it won't feel great, but I'll keep on keeping on. So I do want to call that out.
Yeah, it was like the way I phrased it was, this will hurt. It'll sting. But the machine is going to keep on rolling. So it's not that, and that is to say, position sizing, percentage of your account. This is a ding. It hurts. It's a sting, but the whole point of position sizing is let the machine keep on rolling in other differentiated markets or plays or whatever. Never put those eggs in one basket, no matter what you think is going to happen. No matter how guaranteed some guy on the internet said it was a moonshot, position sizing and risk mitigation always.
Yep. And then the other thing, before we stray too far from should you trade this and we get into options and early assignment, you might get to the end of that and go, well, that's just too crazy. I'll just trade the shares, because if this thing's bouncing around like crazy, I'll short it, I'll long it, And the caveat I'll make, and actually one of the Discord traders that were in here kind of talking about it, made mention, oh my gosh, volatility is high, which usually if volatility is super high and you're, I won't say high frequency, but basically a scalper, you can really pick up some good moves on short-term price action swings up and down. But when you are talking about something this volatile, there is a little thing called a circuit breaker, which can get you. And that actually was what this particular trader in the Discord said, you know what, this thing might hit the circuit breaker, so I'm going to step away. What the circuit breaker is when a particular stock moves a certain percentage in a certain period of time super quickly, the stock market halts all trades on that activity. And it freezes it for a period of like 15 minutes, I think, is the first circuit breaker. Maybe it's 10. You can look it up. It's defined. And then as soon as it starts opening again, it's kind of like holding something over the weekend or holding something after close. You can get gap ups or gap downs. And so you might think you have this beautiful stop loss placed and it's going to save your bacon. But if you hit that circuit breaker, and when that stock comes back online, if you gap past your stop loss or you gap, up or down, wherever it happens to be, you can be in some pain from that. And I do want to call that out there because you'll hear some pain or some risk as we talk about options side of this, which is what Viper and I both did on FRC. Keep in mind, trading shares carries its own risk of a different type when you're talking about this stuff. So,
yeah. Real quick, I want to show one of those circuit breaker events just to emphasize the point. So we're zoomed in all the way here on the 1 minute candles. And it might be a little hard to see on the screen, so I'll narrate it. The candle that I'm currently highlighting is the candle that closed today at 2:43 p.m. Now, the candle next to it, you would expect, is supposed to be 2:44 p.m. But when we go to it, we see that this candle actually closed at 2:48 p.m., which means when we hit the bottom of this candle, the 244 or 243, the circuit breaker hit. The circuit breaker freezes. I believe it's for 5 minutes. I think that math works out. 4 or 5 minutes that it freezes. And so the risk that we're talking about when it could blow past your stop loss is this gap that you see right here between the closing candle and the next candle, which in this particular case represents 2% swing. And there's no guarantee what that gap is going to be because those orders are piling up. And when it opens up, boom, they all get filled. And so, yeah, if you had your stop loss in this gap here, let's say you were super tight on where that candle closed 577. All of a sudden it opens up and you're at 569. And depending on your position size or what you're doing, that could be a significant, unexpected and unplanned thing. And these circuit breaker events usually are not one. It's usually a cascading effect while the market normalizes and these orders get serviced. And so it just becomes a nightmare to try to play. So yeah, that's a good call out of the thoughts from one of the traders in the Discord of, man, really want to scalp this because you can see on here the scalping is super juicy, but it is not worth the risk of not getting orders filled.
Yeah. So the short answer here, well into this description of FRC, is should you trade it? And the answer is probably not, unless you're well aware of the risks that you're undertaking and have kind of seen this before. So one of the traders in the Discord was talking about experimenting on, maybe I should sell an option on this thing. And I said, you know what? If this is your first world into selling premium, I don't recommend starting with this. If you want to try it, put it in a paper account. See what happens with your paper account so you can feel some of this and see some of this. Well, let's talk a little about early assignment risk. And this is something that I, as a trader of premium selling, normally don't worry that much about. So let's refresh a little bit about an option and what it represents. Remember, an option is a coupon where the coupon holder or buyer of the option has the right to exercise his coupon. So if I have a coupon that says I can put shares to Viper at $10, so Viper sold a put contract for $10, let's say I bought it. If I, want out, I can put those shares to Viper and say, you got to buy them at $10. Doesn't matter what the underlying is trading at. Now, one of the reasons that most people buy puts, and in many cases they are traders, investors themselves, and they already have a position in the underlying that they're buying puts for. So maybe I have 100 shares of FDC, and maybe I'm long 100 shares from, let's say, $20. I want to protect my downside, so I will buy a put at $10 for the insurance price of $1.60 a share. So I'm going to pay $160 to Viper just so that he'll guarantee me that if I decide I don't want these shares, I can put them to him, all 100 of them at $10. Yeah, I lose a little bit, but if the stock is, below $10, I don't lose as much as I would have if I didn't have that on there. And so normally the option holders want to keep that hedge on, right? The idea is that company, those shares are going to last for a while. And there's no reason to turn them in early. You want to keep them till the very last minute because maybe you'll be saving yourself more, or maybe it'll turn around and you don't need the hedge. So the deeper you are in the money, the more likely that as you get closer to the expiration, that person or the option holder will say, you know what, there's no way this stock is coming back 200%. I'm going to take this and turn my options in before expiration so I can get my capital and I can move on to another trade. And that's why your early assignment risk increases the closer you get to expiration. If there's 2 months left on your option, you might say, you know what, let's see how this thing plays out for another month, and then I'll evaluate. So that early assignment risk goes down. If you're the holder of a call option, one of the other early assignment risks can happen, because remember, a call option says I can call shares away from somebody. So let's say that there's some dividend payment coming up, and a company is going to pay out, let's say, $1 a share dividend. If I hold a call option and that call option is maybe only 50 cents difference than the underlying, I might want to call those shares away from somebody so I can collect that $1 a share in dividend. And so you have to be careful when you sell calls, because that's another reason that a trader might want to exercise that early and call those shares away. So back to this example of FRC, and this is something that Viper and I had kind of talked about. And I said, this is probably one of these situations where early assignment risk is uber high. Almost it doesn't matter what expiration cycle you're on. And the reason it's super high is because if you open up the paper and you read anything about FRC, there's a lot of people not sure that when we wake up tomorrow, FRC is still going to be a thing. So that's like, if you're faced with that kind of news, do you really want to take a gamble and hang on to it, or do you just want to turn in your hedge and move on to something else? And that's the situation Viper and I tend to find ourselves in. So if whoever holds Viper's contract for $10 decides, you know what, it's currently trading at $5.40, and they might stop trading tomorrow because the FDIC might take over, I'm turning that in and I want to exercise my coupon before I can't. Because once the FDIC, if they come in and take receivership, or if a company declares, bankruptcy and goes off the books, those shares are bupkis. You're not getting anything from that. You won't be able to exercise your option. So once they take it, it's all off the market. There are no more trades happening.
Yeah. And to that point, because it's important to emphasize the point that when the FDIC steps in like that, it happened with SVB, with Silicon Valley Bank. The FDIC doesn't give two cahoots about the shares and stockholders or shareholders. Their primary focus is solvency for depositors. And so they step in and they immediately say, okay, this thing's done. We're done. It's over. Any shares outstanding are now worthless. And we're here with the sole focus of getting depositors their money back. That is our role in society in this case. So like you said, that makes, like, if I'm the one person who bought the contract that I sold them, it's looking pretty nice. Like you said, I do have on the chart here where my expiration is. So for my contract, my expiration is May 26th. But like Sprocket was saying, that really probably doesn't mean anything. I could have August expiration, and whoever's holding that is looking at the same news and looking at the same potential outcome here and looking at the same zero that is potentially on the board, and would rather go ahead and grab these this $10 strike, which at this point is a steal, and even though it could be a loss on their hedge that they have. And let's move on. So I was watching today whether or not to get out before close because these things process for the next day. And obviously I didn't. And I decided, let's see what happens. There's a once in a lifetime event. Let's ride it out.
And honestly, our hope strategy, which hope is not a strategy, but the one of the scenarios that could happen is they go into FDIC receivership, let's say, and they halt trading, shares go away. If Viper and I are not exercised when shares halt trading, guess what? We automatically become 100% winners because we sold our premium and we put that premium in the pocket. And if the option holder cannot exercise, we don't have to deliver, and we got lucky.
Yeah, which could happen if the FDIC steps in before market opens tomorrow. But the reality is probably more on the side of if the FDIC was going to step in, they would have done it by now. I don't know the exact numbers or the situation, but over the past couple of days, I would assume any run on solvency has already happened. And that's a gross assumption on my part. I do not even know if these things are publicly tracked or whatever, but I would assume any run on the bank has already happened. That's kind of what kicked this thing off. So more likely than not, we also have the case prepared where we think price is just going to hang out, maybe keep bleeding, maybe bounce around down here, and this thing's just going to go lame duck until some other bank decides to swoop in and buy them out, possibly for pennies on the dollar. Who knows? That is the risk of the situation. But the longer it hangs out down here, the more likely we are that those people holding our contracts are going to say, yeah, I'm done. I'm ready to move on. And then we got shares of this to then ride out with those shares.
Yep. And to clue you in on my less rosy picture than you, Viper, I played FRC as an earnings play. So I entered FRC prior to the earnings announcement. I did it earlier in the morning before they took their huge ride up. And I sold an at the money $16 strike. So a 16 put. So I'm way up there and I'm way in the money. So yeah. I think my early assignment is pretty much automatic in my opinion.
So you are my canary in the coal mine. If you don't go, then I should be smooth sailing.
Anyway, that is that. We'll keep you posted on how that works out. And if you want to get the more play-by-play, the Discord has been quite full of discussion on this. So anytime something big is happening in the world, I encourage you to come check out our Discord because somebody might be chattering about it and you might pick up some interesting perspectives on it. But let's kind of transition into complete gear change here to a crypto concept of, ironically, very similar to the banking industry of today. And it is a concept of decentralized finance. I'll give a little bit of an intro here, and then Viper can correct me everywhere that I got it wrong, because I defer to him on most crypto topics. But the analogy here is lending that financial institutions do. And think of how you get a mortgage or how you get a loan from a bank. That bank goes to a lending window. It might be the federal lending window. It might be what's known as a prime brokerage, which is effectively just a brokerage company that's got a bunch of money and they lend it out at a particular interest rate. Then whoever receives that money with that interest rate, the bank in this case, would then say, okay, I need to put this money to work, so I'm going to use this money to fund a home loan or a car loan or what have you. And they're going to charge that end consumer an interest rate. They're going to charge that interest rate higher than the interest rate in which they're borrowing. And this is, if you look at bank earnings or things like that, you'll hear it referred to as the net interest margin. And that is the difference, the net difference of how much are they paying out in interest versus how much they're collecting in interest. And the health of a bank will give you the net interest margin, which says this is how much interest they're earning in a whole on their collateral. And to give you just something to connect it back to FRC a little bit, I believe in the earnings announcement, the analysts were expecting somewhere around a 2 to 2.1% net interest margin on the First Republic Bank numbers. I believe that they disappointed, and the First Republic Bank had a net interest margin of like 1.75, 1.75, 1.77, something like that, which means they are actually making 1.77% income on their assets that they have on there. So how does this all translate into the DeFi or decentralized finance? And that is where some products are starting to emerge, where there are these bodies that are collective brokerages, but they're like community brokerages. Everybody deposits their money into the brokerage, and then other people can go to this brokerage. It's not necessarily centrally controlled. There's smart contracts and stuff like that. They can borrow money from that brokerage account at a particular rate, and then they can do something with that crypto. Ideally, if whatever you come up with earns you more than that, what you're borrowed at, you can profit. So Viper, let me switch over to you here and take it away. Help correct me.
No, that pretty much sums it up. As far as an intro to what we're talking about. So yes, while we do happen to have one particular product on the screen, this is a flashing reminder that this is not at all an endorsement. This is not at all an advertisement. To me, this is a very cool concept at a higher level. So we're simply using this website to walk through what that looks like, purely for the thought experiment of, what this world of decentralized finance might look like. And this is absolutely not any recommendation or suggestion to go check it out, because first and foremost, we need to remember and remind that this is a 100% unregulated space, which makes everything we just talked about with FDIC insurances of your bank or anything like that, none of that exists here. None of it. And so at any given time, your money could be gone. Like at any given time, whoever creates a project has, back doors or whatever, they can walk away and there is no insurance left for you. So just want to drive that point home, and we'll do it every single time we talk about a crypto project. But I do believe, like I said, the concepts are very intriguing and very interesting. And when we get through this current just start of a regulation season, man, I would hope or enjoy to see some of these things exist to the other side, to see the light of day, because there is a lot of very cool power in this. So all of that said, on the main page here, what we're going to do is just revisit the concept of what Sprocket just laid out. So in this particular platform, you have two sides of the coin you can be on. You can be on the depositor side, where you just show up with an asset and you deposit it and you earn an interest rate on that. So that's the depositor side. And then the other side of the coin is if you want to show up and borrow those funds that somebody is offering to be borrowed at a particular rate of leverage, up to 5x leverage in this case, in which you will pay the interest rate that funds the depositor's rewards. So real quick, the depositor side is pretty straightforward. So again, I want to try to keep as much as I can without getting too lost, try to keep the parallel to the banking system of what Sprocket just laid out. So in this scenario, you, the user of this website, are either on the prime brokerage, we'll just call it the prime brokerage side, or you're on the bank side. So this page, the deposit, would be if you're on the prime brokerage side. And so what you are doing is you are instead of the prime brokerage being one massive institution, one centralized entity with billions of dollars that is offering these up to be borrowed by the bank. In this case, it's a pool of many, many, many people pitching in to constitute one giant pool of funds that the other side can borrow out of. So we can kind of see here on the page what the size of these pools are across these different assets that somebody can borrow. We don't need to worry about what they are, other than, I'll say the USDC and USDT are both pegged to $1. They represent the dollar on chain. But you can see the pool sizes here are decently sized and growing as this platform grows. But you can see utilization here. And so, because again, we're talking about a coded world, we're talking about decentralized world where there is no overarching body, but there are conditions we can put into code to protect depositors and borrowers. And so in this particular case, as the utilization rate of a particular pool goes up, that puts at risk that bank run, in the fact that it can't support a bank run. Like this particular pool for USDC is 78% utilized. So if 30% of the depositors showed up and wanted to withdraw their money, the protocol would not let them up to 100% utilization, and that's to protect the borrowers as well as the depositors. So how do you reconcile that as a piece of code? Well, you start cranking up the interest rate. What this does is it encourages whoever's borrowed that money, they're now paying extra interest rate, so it encourages them to return the money. At the same time, you, the depositor, are not so antsy to get your money back, because now you're starting to earn more interest on the money you've deposited, and eventually the pool balances out because people start to fade out on the borrower side. They return the money, or they get liquidated because there is leverage in this scenario, or they get liquidated and the money comes back, and then you can withdraw. So the protocol is coded to protect the interests of both parties here, and that is just one way it does that with the utilization. So that's pretty much all it takes on the depositor side. You simply show up. It's called single-sided staking, where you take one asset, drop it in here, get your interest rate, and so long as the pool is not maximally utilized, withdraw your money whenever you want, and move on. So why in the world would somebody want to borrow at an 11.5 interest rate or worse? Because 78%, this curve goes up fairly quickly when you get closer to 100% utilization. Well, I mean, it's like, why would any bank want to borrow money? And it's because they feel like they have a plan and an opportunity in front of them where they want to borrow that money. They believe they can go make more money than the interest rate they borrowed with. And so therefore the delta is a net positive in their favor. And it's the same exact thing here. So switching now to the bank side. So now this is where you would go if you wanted to borrow funds. So now we're acting as the bank. We could come in here and you can see the borrow rate. We could borrow any of these assets at this rate. And we could borrow that, like the page said initially, up to 5x leveraged. And the reason we would want to do that is whatever our opportunities are on earning on this, it's amplified by having leverage on the asset itself. So we'll skip the details of what these farms are because it's not an introductory course. And because there's no funds in this account here, we don't actually see the APY here, but I happen to know, like on this SAVAX farming strategy, the max APY is 30%. So now all of a sudden, if we go back and look, oh, that makes more sense. So if I borrow, let's say AVAX, convert it to SAVAX, and then stake it into this pool at a leveraged amount, I can increase. The minimum is 11%. The maximum is 30%. So the more leverage I apply, the more APY interest or yield I'm gaining on that base asset bag, because I'm earning the interest on the borrowed funds I need to return them, but while I hold them, I can earn interest on them and thus increase my earnings potential and thus justify the interest rate at which I borrowed that for. And the last thing I'll mention that I find interesting here, probably, probably a little too detailed, might gloss some eyes over, but the concept of asset accumulation in this particular case. So that example that I used of borrowing AVAX and using and switching it to SAVAX and then getting this 30%, AVAX and SAVAX are just assume their price is in lockstep together. And so that means I borrow at leverage. I come over here and I stake it. I get 30%. Now my liquidation risk, which we'll use the term delta because that ties into what we talked about with the delta on certain options or things like that. The delta in this case is zero, but it's zero because I'm not at any risk of getting liquidated because the borrowed asset and the collateral asset that I have move in price together. And so now by having a zero delta, we are able to purely accumulate that 30%. And so that sort of equates to, Sprocket's delta neutral strategies where he talked about trying to be delta neutral in order to collect that premium on options sold and focus on only collecting the premium with little risk of what the market is doing. So it kind of feels I feel like it has a parallel here to that. Though the main point is just the world of decentralized finance opening up the opportunity to act as the bank in this particular case and a method of earnings that is not generally open to the retail public because it is the bank serving that function. So what happens when the bank isn't there? And this is just one example of what that potentially looks like. And so I don't know if this protocol strikes you, Sprocket, in any other ways or anything to add. Though I do know you have some non-blockchain experience with similar lending protocols of the early 10s that I thought kind of plays very, very nicely into now having it in a blockchain form where there are some more coded protections in place.
Yeah, no, I like this. In fact, I've even started dabbling in one of these with just a tiny little amount. I think it was a total of 1.5 AVAX that I'm kind of trying out because I get it and it makes I'm excited about it because it's kind of cool. You really are taking that central bank out of things, and you're opening up the opportunity for individuals to participate like a bank, and kind of control some of that risk and leverage. The piece that I really like about it is my objective is we've talked about on this show before is I want to be a staker of Avalanche or a staker of any crypto. Avalanche happens to be the token I'm chasing for a multitude of reasons. But in order to be a staker, you have to accumulate so much of a particular token to basically put up as proof of stake. So you kind of got to pony up a large chunk to say, trust me, I'm putting these assets up at stake, and if I do a bad job, you can take them from me. And so in order to do that, I can kind of do some accumulation of it, but this opens up the ability for me to do that accumulation at 5x leverage. So if my method is generating, let's say, 1 AVAX a month, switching over to this leveraged ability, I can then crank that up to, 5x that, 5 tokens a month. And then the thing that I really like is your leverage is dependent on that debt to equity ratio that Viper was alluding to. So if you nicely balance the two assets on there, the asset that you have the debt on and the asset that you have the equity on, means what you loaned out, and you keep that in a manner that keeps it balanced, you don't run the risk of a margin call or a liquidation, right? If you don't keep that balance and your debts become too high, the contracts protect all of the lenders and say, no, 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 this guy's getting too risky. Let's cut him off. Let's liquidate his stuff. And then, if I was the guy tipping the scales, now I'm out my money because I got liquidated because my debt got too high to my equity. If we are careful on what we select, we can select things that Viper said move in lockstep. So that, yes, if the price just totally crashes on the thing that we have, if it crashes equally on both sides, yeah, our total value is down, measured in US dollars. But remember, my point is not to accumulate value in US dollars. My point is I want to accumulate AVAX tokens. And so if the method that I choose to do, which is what I've done, is balance this AVAX and constantly grow that AVAX number. I personally don't care what AVAX does price-wise, because at the end of the day, I need 2,000 AVAX to be a staker. So whatever drives me there in the most passive, low risk means, not susceptible to price swings or things like that. Like I could try to scalp my way there, but yeah, if I screw up a scalp, I could then be resetting my climb up. So I want to always, positively climb. And this affords me that opportunity.
Yeah. I think the last thing I want to call out, just from an education exposure perspective to this, is realize, especially anybody that is not familiar with the space, there's so much there to unpack. And the initial impression is probably, what the heck? And so the one thing I want to impress above anything is the importance of understanding what you're getting paid in reward or yield, where is that coming from, and how sustainable is that? And that's especially important after the last year that crypto has seen, where so many major institutions, FTX, all these big names that put a lot of money into marketing, were attracting depositors because they were promising things like 20% on your deposit, and zero information was given about where that money was coming from. And in the end, it turns out it was not coming from anywhere sustainable. And thus we had all these collapses, and people were losing money left and right, because those institutions were acting like traditional institutions, where they were taking the money and just leveraging it out and all this kind of stuff. So it is paramount that when you're getting a yield in any space, so I mean, this goes into fiat and traditional finance as well, that you understand where is that money coming from. One of the things I enjoy the most about the blockchain and decentralized finance world is that where that money is coming from can and should be transparent and traceable. And if it's not, then I'm out. I don't want it. And so that's a power that you can't hide. The blockchain ledger does not lie. And these protocols, these contracts are publicly readable. I can look at and audit and see that they're coded to do what they are marketed to do. And so that's not to give any illusion of security or safety, because like I said, still completely unregulated space, still rugs happening all over the place and people losing money. So it's more so just a highlight that I think is very interesting about operating in this space versus operating in what is really a very black boxed world of traditional finance and stock markets trading, dark pools, things like that, where order books are sold and traded and all that kind of stuff that hides in the curtains that the blockchain doesn't let hide just by default.
Yep. And I would just re-echo you hear us talk about it all the time. Understand what you're trading, understand what you're investing in. It's one thing to see a nice, pretty box and go, ooh, the label said it would do everything. This is amazing, as seen on TV. But until you can really understand what is the thing you're buying, how does it work, what makes it tick, That's really your best defense in any investment strategy is what makes the thing go whir. And so that brings us to the end of this week's episode, kind of touching on quite a bit actually in this from the, should we trade these front and center news article crazy volatile type stocks and make millions by scalping all of this stuff, in how that pans out. Well, I think we covered some of that, and you could, but it's not really recommended, and you really got to understand what's happening there. That led us into bringing that great example of early assignment. What the heck does it mean what do you mean the option holder's turning his option in and I'm getting assigned? We'll see in the coming days, if Viper and I get assigned and I get to hold another nice bag of a bank company that hopefully won't go defunct if I get assigned. Hopefully they go defunct before I get assigned, but who knows? And then, tying all that to how do we become the bank? And, that's this is one of the most practical applications of this decentralized finance that we've kind of come across. We've come across other ones in previous shows that we've talked a little bit about. Aave is one of the ones that come to mind, and it's this passive lending strategy. This one's super interesting because we can apply leverage to it. And so again, it just goes back to this: understand what you're doing. Don't just do something because a couple of random guys on the internet who have a YouTube channel mention something and you're just jumping full in. Or maybe one of those guys and you're like, well, if he says so, I know him. I've seen him before, so let's do it. I cannot stress enough, whether or not it's trading highly volatile stocks, if it's selling options, if it's investing or putting money into a DeFi program for leverage, like, open the hood, take a look, understand, ask questions, say, wait a minute, but why does, and just keep asking why. Find articles, read them, hop in our Discord, ask us, ask some of the other traders in there. The more you know is absolutely your best defense in risk mitigation.
The last thing I'll say on that is, if you go down the question rabbit hole and you have a critical question and you're not finding an answer, that's your answer. You just hold off, back off, and wait. Maybe leave it forever, that sort of thing. Don't be afraid. Don't plow through an important question and go, well, I got 9 out of 10 questions answered, but I couldn't understand this last one, so whatever. Like, that's not good enough. Like, get every question answered. Otherwise, find something else.
Yep, definitely. And there's things that Viper has brought to me. He's like, oh, and I'm like, buddy, I just don't get this part. You've tried to explain it, but it's not connecting in my brain. And I say, good luck. I'm sitting this one out. And he does the same thing to me when I'm like, but here, there's this, you gotta check this one out. And he was like, nope, not for me. Everybody has their own flavor of investing, trading, what have you. And if it's not for you, it's not for you. That's an okay answer. Well, I hope you guys, there's more earnings to come. This has been one huge eventful week with, First Republic. We had Microsoft, Google, Facebook, Amazon's coming up. Just all the big heavy hitters doing earnings this week. Things bouncing all around. We got CPI numbers or GDP numbers coming out as well. Next week, we got a Fed meeting, just action-packed. So have fun out there. Be careful. Good luck. And remember, think outside the block.